Hi, this is Sheldon here from the Currency Advisory Desk with today's report. Well, the dollar-rupee pair has been riding a roller coaster for the past few days. Now, we have been witnessing movements in excess of a percentage point in this pair, and this does sound pretty alarming, as such rapid movements were only associated with the yen-rupee pair earlier. After hitting an all-time low of 58.98, the pair rapidly rebounded to give a close at 57.80 yesterday. Now, we had the CPI and IIP figures for the month of May and April released yesterday. While the former came in better than expected, the latter was a huge disappointment. Now, the IIP fell to 2% as compared to analyst expectations of 2.6%. Even though the CPI came in lower at 9.31%, with the current economic conditions, we doubt that the RBI may even consider a rate cut during its meeting on June 17th next week. Now, we expect the dollar-rupee pair to be extremely volatile and advise our traders to go long in the pair on every dip. Even though the Finance Ministry is planning to introduce some more measures to curb the fall in the rupee, we foresee these to be very short-term. Now, traders can go long in the dollar-rupee pair at current levels, that is around 57.75 to 57.80 in the spot. Now, we will be getting the WPI figure tomorrow, which will provide a better guidance about RBI's stance on easing. Internationally, among the G7 currencies, the US dollar has weakened against all others. The US dollar index is down to 80.90. Now, the euro-dollar pair is trading at 1.3356, and we expect this pair to move higher. On the fundamental front also, we had an increase in industrial production figure for the Eurozone, which came in at 0.4% versus an expectation of minus 0.2%. Now, we do not have any major data scheduled for today from the Eurozone. However, we will be getting the CPI and change in employment figure tomorrow. In rupee terms, traders can go long in the euro-rupee pair at around 77.50 levels. Now, the pound has also strengthened against the US dollar and is trading at 1.5682. It hit an intraday high of 1.5701 yesterday. Now, we expect the pound to test the 1.5750 to 1.5800 levels in the short term. Now, with the unemployment rate in United Kingdom coming in as per expectations, we do not have any major data from UK for this week which can rattle the pound. Now, traders can go long in the pound-rupee pair at around 90.80 levels. However, we do not see the pound extending a huge rally against the Indian rupee, as it seems overvalued at current levels itself. So, traders can look to exit their positions with a profit of around 20 to 30 paise on the upside. Now, the Japanese yen had a spectacular pullback against the US dollar yesterday. We saw it hit a high of 95.14 from a low of 97.02 against the US dollar. Now, after the World Bank lowered its global growth forecast to 2.2%, global equities and the US dollar gave up its gains on account of flight of capital to safer havens. Now, we expect the yen to move to around 92 to 91 levels in the medium term. Now, traders can go long in the yen-rupee pair at around 61 levels in the spot. Now, looking at the economy, well, even though the Indian economy got a revised outlook from global ratings agency Fitch yesterday to stable from negative, we do not see any structural changes happening here. Now, the government is pushing for reforms, the latest being the increase in investment limit of foreign portfolio investors by $5 billion, which takes the overall limit to $30 billion. Now, this, along with news of reintroducing the NRI bonds by economic advisor, seems a positive step for the Indian economy. However, all these measures are being countered by what's happening globally. With constant rumors that the Fed will taper the QE, investors are preferring to sit on cash. Hence, we are seeing this huge pullback and increased volatility in markets worldwide. Now, the brunt of all this has been on emerging markets currencies, which have fallen by around 4 to 6% in the recent past. Now, the concept of hot money exiting these markets, especially India, is what is causing all this chaos. Now, we expect this to prevail till the Fed saga doesn't settle. Now, we have a FOMC meet next week, which may throw some light on things to come, besides our very own RBI credit policy. Till then, traders are advised to alter their risk profile and hedge their overnight positions using options, whatever the strategy may be. Well, that's it from the Currency Advisory Desk. Thank you.